So the question of the day is, are we in a bull market again, or are we still in a bear market, or are we somewhere in between? Um, it's kind of hard to say unless you're paying attention to the charts and using a tool such as stage analysis that I use kind of simplifies things unless you understand where the market is in its cycle and what kind of action you should take based on the current condition of the market. So if you go to my screener at screener.nextbigtrade.com, on the markets page, we can go down and look at U.S. markets and see that the S&P 500 and the NASDAQ, as signified by the triple Q, are back in a stage two, and the transports and Dow are still kind of in a stage one phase. So the US markets are trying to repair themselves from, the August plunge, obviously, but it's still, kind of early in a new uptrend, and especially with the amount of resistance the market has to overcome, it's still quite possible that we continue sideways for a while. But the key thing to note is that really the recovery is still being led exclusively by the U.S. markets. If we go to the foreign stock markets, they're all still in stage four, essentially. These are all the major foreign stock markets. And then if you go to emerging markets, they're all still in stage four as well. So this bull market, or this potential new uptrend, is still exclusively a U.S. phenomenon. And the question is, does the U.S. really have the ability to lead another new up leg in the markets, considering the fact that the U.S. has been leading for multiple years now? And what I wanted to focus on more in this video is that the strength in the U.S. markets is very concentrated. It's really just mostly in technology and consumer discretionary. As you can see here, technology and consumer discretionary, XLK and XLY, are back in stage two, but we still have healthcare, materials, and energy in stage four, and financials and industrials are still working out of stage one. So only a few select markets within the U.S. stock market are back in an early uptrend. And let's take a look at the charts next to take a look at this. So if you look at XLK, it's been outperforming the S&P 500 for 2 years now, and it's already back above the 30-week moving average after the massive August meltdown. So really, this technology is leading the stock market. Same with consumer discretionary. It actually underperformed the S&P 500 in 2014, but is now outperforming by quite a big margin, actually, in 2015. And this ETF has things like Amazon and some of the larger cap consumer discretionary stocks that are actually the ones that are mostly leading the market. Looking at like the next couple of sectors are ones that are still kind of trying to overcome the resistance from all of 2015. Financials are a key sector, and notice how they're still kind of treading water against the S&P 500, and still below this resistance level. And this is a key sector to watch to see if the U.S. stock market can continue higher, or if it's going to potentially roll over back into a bear market. Same thing with industrials. Notice how industrials have actually been underperforming the S&P 500 all year, and started actually back in 2014, before the industrials made a final top. And The key thing to note is that we're back above the 30-week moving average, but it's sloping downward now. So, you know, this is kind of the telltale sign of an early bear market if we fail here and fall back below the 30-week moving average. Looking at semiconductors, we're supposed to be one of the leading sectors in technology, but they are still struggling, kind of similar to financials and industrials. They are back above the 30-week moving average, but they are treading water at best with the S&P 500. So stock market bulls want to see semiconductors, regain form and continue to move higher because they were a former leadership sector. You can see they helped lead the market in 2013, 14, and into mid 2015. Only since the summer they've rolled over and now are kind of a underperforming to flat portion of the market. Healthcare is a major trend change potentially for the market, and this is something that I'm keeping my eye on very closely right now is how the XLV continues to behave right at this 30-week moving average here. If we see XLV fail to retake this 30-week moving average and continue to roll over, then that's very bad for the U.S. stock market. And that signifies that the healthcare, which is really what led this bull market from 2011, is finally rolling over, and we can see that it's finally underperforming the S&P 500 since August, which is, it hasn't done that for multiple years. So, this is a lot of money is in this sector now, and if this starts to roll over, then the market's going to be in big trouble. But vice versa, if this does regain the 30-week, then that's extremely bullish for the market. So this is a very important sector to watch. Same thing with biotechnology. This is the portion of the healthcare that really was outperforming, but now it's under a lot of pressure. So it's not even above the 30-week moving average right now, and we've made another lower high potentially. So biotech is under warning for potential bearish developments. Materials have been, they actually were dragged higher with the bull market up until mid 2015, and then they've just gotten crushed since then. So this shows you that what's been going on so far in 2015 isn't just, a mere correction. A lot of sectors and stocks are taking significant damage right now, and only because like certain large cap stocks like Amazon, Google, Facebook, they're pulling the major indexes higher, but underneath the surface, there's still a lot of damage that needs to be repaired, and materials is one of those victims. And look at how they've been underperforming since late 2014. Retail is interesting because retail was kind of a former outperformer in the market, but it's having trouble at the 30-week moving average again, and it's also underperforming the S&P 500. And this is the XRT retail ETF. But if you look at RTH, which has a different composition, the same thing starting to happen where the 15% of this ETF is Amazon. So you can see how a larger cap stock like Amazon's helping hold this thing up because it's done so well this year. But we're still at a point here where RTH could start to underperform the market if it kind of fails down below the S&P 500 here. Finally, transports is another sector I've been watching closely because they started underperforming or falling below the 30-week moving average back in April, and ever since then they failed to retake the 30-week moving average. So they're displaying classic stage 3 topping and stage 4 decline type of action. We've got another tight coil here in the transportation index, And where this breaks out, I think will play an important role to determine where the market's going. If we see a break higher, I would interpret that to be very bullish because this sector could actually start taking over leadership, given the fact that it's underperformed for a year and a half now. But at the same time, if it breaks down more, then that's another bearish indicator for the market. And notice again how it's been underperforming the S&P 500 for most of 2015, but if it breaks back above here, that's got to be interpreted as bullish.